We all know REITs allow retail investors to invest in commercial real estate, generate truly passive income through dividends, and diversify their portfolios. Today, let's talk about one of the top 10 global REITs with $40 billion in market cap. It has delivered 27 consecutive years of increasing dividends year over year, with a dividend yield of 4.3%. That is comparing to 1.4% yield of S&P 500, or 3 times the amount. In fact, it is named one of the 64 S&P 500 dividend aristocrats, known for paying high and consistent dividend. It also has a monthly dividend payment schedule, which is pretty unique among REITs. The company is Realty Income, ticker O.
Realty Income basically acquires, manages, and develops freestanding single-tenant commercial properties. For example, their customers include Walmart, Walgreens, CVS, Home Depot, or even restaurants, whether it is dine-in or drive-through, such as KFC or Buffalo Wild Wings. Basically, the underlying real estate, the commercial property itself, is owned and managed by Realty Income. Over the past 53 years of its operating history, Realty Income has built a portfolio of over 11,700 commercial real estate properties that generate over $3 billion in annual rents. These properties are located all across US and also in UK and Spain. Their top high quality clients, for example, include drugstores, dollar stores, convenience stores, grocery stores, as well as movie chains and gyms.
In fact, Realty Income has been so successful, its stock has beaten the market since it went IPO around 30 years ago. It delivered a 14.4% average annual return compared to around 10% across S&P, NASDAQ, and REIT in general. In other words, Realty Income has beaten the market by around 50% over the same period.
The secret sauce behind the success of Realty Income comes down to its unique business model that combines three elements, starting with stability across business cycles, including recessionary environments, while doing it in a profitable way, as well as growing across the business cycle. Hence, it delivered superior risk-adjusted return for the last 30 years. In the next few minutes, we are going to talk about why we believe Realty Income is the best REIT stock to buy and own for 2023, but also beyond for long-term investors. Right now, it's trading at $64, which is almost 26% lower compared to its pre-pandemic high, hence presenting an attractive entry opportunity for stock investors.
Great, let's start with how and why Realty Income was able to deliver stable and solid performance. Heading into 2023, the top two concerns for investors are the looming recession and the high interest rate environment due to Fed's interest rate hikes, and Realty Income provides a way to navigate this environment.
All right, so history speaks for itself, or at least it should. Why don't you discuss how Realty Income performed during the Great Recession, meaning the 2008 financial crisis?
Good idea. During recession, intuitively, you would think companies' financials would suffer significantly, but that was not the case for Realty Income during the 2008 financial crisis. Let's look at Realty Income's performance during this period against its top REIT peers with the highest quality rating, credit rating. Across key financial metrics such as rental revenue, profitability, EBITDA, and occupancy rate, Realty Income delivered the least or less volatility compared to its best-in-class peers, therefore demonstrating its excellent ability to navigate a recessionary environment successfully.
Awesome. So speaking of history, how did Realty Income perform during the last interest rate hike cycle?
Sure, in general, Realty Income stock did very well during the last Fed hiking cycle from 2015 to 2018. 1 year after the Fed started hiking, Realty Income delivered 13.1% of total return, which was almost twice as high as the REIT sector in general and slightly beating S&P 500. Even better, over the 3 years of hiking cycle, Realty Income delivered more than 44% of total return, which was 50% higher than S&P 500 and more than 200% higher than the REIT sector in general. In short, Realty Income tend to outperform the market during a rising interest rate environment.
Well, the answer to why Realty Income was able to perform better during this recessionary and high interest rate environment is because of its diversified real estate portfolio that has over 1100 different customers or clients that span across 79 different industries all over US as well as UK and Spain. In fact, 78% of Realty Income's rental income is generated from its retail customers. And Realty Income has a specific strategy that is focused on leasing out their properties to retailers that offer non-discretionary products and services, such as consumer staples. Think about groceries or toilet paper. And think about retailers such as Walmart and dollar stores that offer a lower price point. So these essential products are required regardless of the economic environment, including during recessions.
Yeah, you're right. It's a deliberate strategy. Looking at Realty Income's top 20 tenants, they clearly fall under at least one of the three categories, including non-discretionary, low price point, and service-oriented. The focus on high-quality tenants paid off when you look at their high and consistent occupancy rate over the past 30 years. It never dipped below 96% and is now standing at almost 99%. Not only did they have high and consistent occupancy rate, they outperformed its peers in the past 2 decades on a median basis or during the lowest year.
In addition to best-in-class occupancy rates, Realty Income also exhibited superior stability versus other S&P 500 REITs in terms of other metrics. For example, in terms of dividend growth, Realty Income had 0 years of negative growth compared to at least 2 years of negative growth for its other S&P 500 peers. In terms of total shareholder return, Realty Income had only 1 year where it generated less than minus 10% of total return compared to 2 to 9 years of less than 10% return for its peers. And it has been doing that while maintaining the second highest quality credit rating in this time frame.
So, all in, Realty Income's stable and consistent performance protects investors from economic downturns and recessions. Now let's pivot to the second component of Realty Income's secret sauce, which is profitability.
If you own a real estate property, as you know, outside of paying your monthly mortgage, there are other several types of expenses that you do incur, such as paying for annual property taxes and property insurance and any ongoing maintenance and repair type of expenses. Realty Income structures its leases with tenants in a triple net lease model or a triple N model, where the tenants are responsible for paying all these additional expenses.
The triple net model allows Realty Income to be a lower cost operator across business cycles. This is especially beneficial in a high inflationary and recessionary environment like 2023 because Realty Income will be able to pass the higher costs such as labor and goods to maintain the properties to its tenants.
In addition, Realty Income has been becoming more and more operationally efficient. If you look at their general and administrative expenses, meaning your corporate function costs such as HR, IT, legal, compliance, accounting, these costs have been coming down. They were 5.8% as a percentage of total revenue in 2000. Now they came down to 4.3%. The same costs as a percentage of the total book value of the assets, they were 64 bips, meaning 0.64%. Now it came down to 0.34%, hence becoming more and more operationally efficient.
As a result, Realty Income has a high EBITDA margin, reaching more than 95% in 2022. As a matter of fact, they have grown earnings per share in 25 out of the past 26 years. Not only has Realty Income been growing its profitability and improving operational efficiency, it is also the best in class when comparing to its peers. For example, in terms of G&A as percentage of total revenue, while other REITs would spend $9 out of $100 on G&A, Realty Income only need to spend half of that. The comparison is even more stunning when you look at recurring capital expenditures or costs associated with maintenance. While other REITs in other sectors such as healthcare, shopping centers, industrial, and office, they need to spend around 6 to 9% of their annual net operating income on maintenance. This figure for Realty Income is only 0.5%, and that is because of its triple net lease structure, which means maintenance is paid by the tenants.
Okay, so shifting gears into the third and final ingredient of the secret sauce recipe of Realty Income, the growth. Okay, so when you think of Realty Income's core business strategy of owning and renting out real estate properties to high quality tenants that are focused on lower price point or non-consumer discretionary type of business models, you may think that Realty Income is a bit conservative. But don't be fooled by that, because if you look at the last 10 years of acquisitions that Realty Income has made, for example, in 2013, they acquired American Realty. That's another REIT that's focused on single tenant, triple net lease model for $3 billion. In 2021, they acquired VEREIT, one of the largest triple net lease companies or REITs, for a whopping $17 billion. And this bold strategy continued into late 2022. So they recently acquired another portfolio of properties for $0.9 billion in Texas and Illinois area that are focused on triple net lease model.
In addition to acquiring other REITs, driving organic growth is also their DNA. In the past 12 years, Realty Income deployed $33 billion in acquiring, developing, and redeveloping properties. While the investment has accelerated in 2021 and 2022, they do not sacrifice on quality. For example, in 2022, Realty Income started with a $78 billion pipeline of investment opportunities. Through a lot of due diligence and data-driven research, by the end of the year, only $5.1 billion made it into the final investment, so very selective.
In addition to its phenomenal success within the US, Realty Income has started to grow internationally, expanding overseas, basically acquiring 255 properties in UK and Spain over the last 2-3 years that ended up contributing more than $300 million in annual rent, basically contributing around 10% of total Realty Income's rent. They're trying to replicate the success that they had in the US in the international markets. For example, their high quality tenants outside of US, such as Sainsbury's, Tesco, Carrefour, and Asda, which are equivalents to our Walmart, Kroger, Trader Joe, and Costco, and another client such as B&Q, which is equivalent to our Home Depot. So deploying the same playbook in international markets.
Outside of the traditional focus on retail, Realty Income has also been expanding into new industries in a very opportunistic way. For example, casinos and vineyards were heavily impacted during COVID. Leveraging their expertise and reputation and scale, Realty Income was able to identify large properties like casinos and vineyards and probably bought them at a discount to market rate and then leased them back to their original owners and leveraging their triple net lease structure. And therefore, these deals were a smart way to diversify their portfolio and at the same time drive growth. By now, we all know Realty Income is a big player in the triple net lease space. However, the total addressable market or TAM of net lease is gigantic. For example, in the US, the TAM is estimated at $4 trillion, while the public REITs in net lease space is worth $150 billion, or less than 4% of the total market. In Europe, the net lease TAM is even bigger, estimated at $9 trillion, while the public REITs are only worth $3 billion, less than 1%, truly a drop in the bucket. The takeaway here is large players like Realty Income is well positioned to consolidate the net lease market with huge white space for growth. So to summarize, stability, profitability, and growth have contributed to Realty Income's superior risk-adjusted return. Realty Income has delivered superior return in terms of total shareholder returns. If you invest $100 when Realty Income went IPO in 1994, that same $100 would become $3,500 by the end of 2022. For every other indices, such as S&P, NASDAQ, Dow Jones, or REIT index in general, that $100 would only become $1,300. So Realty Income outperformed these indices by about 1.5 times. Even better, Realty Income's amazing return comes with very limited downside risk. For example, when you look at total shareholder returns downside volatility, Realty Income is the 6th lowest among all of the 500 S&P constituents. So truly a perfect balance for higher return and lower risk.
End of the day, the traditional age-old wisdom is risk versus reward for any investment we make. So if we plot all S&P 500 companies in terms of these two metrics, the reward, meaning the total return in the last 30 years on y-axis, and the risk measured in terms of beta on x-axis, you can clearly see that Realty Income is on the top right corner, meaning delivering not only best-in-class reward, but also delivering the least risk. Doing the same exercise for Realty Income versus the other S&P 500 REITs, Realty Income is really the best in class. In fact, the second best, delivering more return per unit of risk. All right, the million-dollar question. What is the right entry point to buy O?
First, let's take a look at Realty Income's share price performance in the past 5 years. Up until the pandemic hit in early 2020, its share price steadily rose, and then it took a big hit just like any other retail stocks because in-person shopping was temporarily closed during the pandemic. And then it gradually recovered, but as of now, the share price is still 26% below pre-pandemic high, representing a potential entry opportunity. In terms of valuation, on the basis of forward price to AFFO, or the equivalent to PE for other regular stocks, Realty Income is currently trading at 16.2 times. Comparing to its 10-year average at 18.5 times, the valuation is relatively low. We also sense check by looking at analyst ratings. All analysts rated the stock as either buy or hold, none of them rated it as a sell. In terms of target price, the median target price is at $70, representing a 10% upside compared to current share price. However, keep in mind that analyst target price is based on a 12-month period. For long-term investors, Realty Income is well positioned to generate more attractive return for the long term. All in, we would be comfortable buying the stock right now in the $60 range, and we would keep buying the dips if it falls below this range. Thank you for joining us today. Please don't forget to like and subscribe to our YouTube channel SafeSea for other best stock ideas.